There were 19 million visitors to Singapore in 2019. But the Singapore Tourism Board says visitor arrivals this year could fall by about 25 to 30% due to the Covid-19 outbreak.
SARS during 2003, what we have seen is that the hospitality, or more so the retail sector, as well as transport, they have been down by over double digits during just in second quarter of 2003 alone. And if that plays out similarly to 2020, the key industries that would likely be affected would be the F&B as well as tourism as well. And by that, we will not be surprised to see also a similar double-digit contraction for these two sectors for the year.
In 2019, tourists spent 27 billion Singapore dollars, a marginal increase from 2018's level. About $1.8 billion was consumed by food and beverage, while over $4 billion went to shopping. These numbers may fall in 2020 due to the virus outbreak.
The Restaurant Association of Singapore did a survey of our members, and close to 60% of them believe that over the next 3 months we're going to drop by more than 50% of revenue.
That sentiment was also echoed by retailers.
Since the beginning, the business has been affected very badly, and this is very unprecedented. Some people affected only 30%, some others until 90%, even 100%, because it varies. At the same time, the downtown shops or shopping malls, the business have been affected even badly than outskirt malls.
There has been a virtual halt in travel to and from China, which is the largest source market for Singapore's tourism industry.
Always in Singapore, mostly 20% tourist flow is from China. Now it is completely stopped. Many other countries are trying to avoid Singapore at this moment. Naturally, it is going to be affected, all tourism-related businesses.
In the 2020 budget, the Singapore government unleashed a $4 billion package to help businesses and workers affected by the Covid-19 outbreak. Measures include rent and tax reliefs, as well as cash flow and wage support schemes.
$2.4 billion worth of support for workers' wages. That's amazing, and we really appreciate that. But as you know, those sort of measures will take some time to come into play. And I do stress again the importance of short-term measures like rental rebates from the landlords. Yes, they're getting property tax rebates, and hopefully they'll pass it on. But that's the government passing on to them and then passing on to tenants. So we hope that they can do a bit more.
Manpower, as well as rental costs, typically make up more than half of a restaurant's operating costs here. Landlords like Jewel Changi Airport, CapitaLand and Fraser's Property Retail have launched various relief measures, including rent rebates, to help its tenants. However, businesses hope more can be done.
They are simply asking us to get from the landlord the GTO rental, that is percentage rental on the sales. If they charge reasonable percentage of that sales, they are all happy. We are working with all the landlords together with the RAS, Restaurant Association, with the help of ESG, Enterprise Singapore, together. We are meeting the landlords every other day, and we are also meeting the banks, and we request them to support very quickly for all the affected retail business and restaurant business.
I think also the question really is on the skills futures. So one of the proposals out there really is to tag the skills futures program to jobs, basically for enterprises to actually utilize the skills futures credit and promise and give clarity on the jobs scope and the retraining prospects for the workers.
Despite the grim outlook, current retail rent prices may still stay firm in the near term.
At the moment, I think a lot of landlords are still assessing what's the risk really to the retailers. So in any case, I think the pickup really is coming in after Chinese New Year, which is usually March period. So I think landlords are not going to jump the gun and to say, I'm going to give you a rental discount of 30%. That's not going to happen.
Lower footfall at malls also doesn't necessarily translate to higher online sales across the board. This is because consumers are only spending on essential items.
People are not going to wish to spend in a very discretionary way, because they'll be fearful that they're going to maybe lose their job, maybe their income's going to be blighted, maybe their wealth's going to be coming down. So all of that sentiment, that negative sentiment, will weigh even on the online retailers as much as it will with those companies that are in shopping malls.
What is not essential, they are not spending, whether it be it online or brick and mortar. Online business is still there. The same percentage has been happening what was there before, but it is not affected very badly, but it is a very, very small component for generally the Singapore retailers is the online business.
For investors with portfolios exposed to the commercial property space, is it then time to cash out?
A lot of the reinvestors, I think, really long term. Definitely not short term like 1 month, 2 months, because if you look at the model, it's really about recurring income. From the fundamental perspective, these retail REITs are still very sound. So I wouldn't think that over the medium to long term, there is really a lot of the risk into the commercial REITs market.
We've certainly got pressure on rentals. We've got pressure on other sources for the REITs, and that turnover will clearly be down. But there's a price at which something becomes attractive. So those yields may go up as prices come down. Once you get into yields of 6, 7, 8%, in the previous crisis, yields got as high as 10. They were an outstanding opportunity for long-term investors.